In this video, I'll tell you exactly what is meant by a stock split, and we're starting right now. Hey guys, Elliot here. So if you invest in stocks, chances are you may have heard of stock splits, but what are they exactly, and more importantly, why do they happen? Well, a stock split is nothing more than a corporate action where the company splits its shares by issuing additional ones and slashing the stock's price accordingly. The best way to understand this is by example. Let's say a shareholder has 10 shares of a certain company and these shares are $100 each. Thus, the shareholder has 10 times 100 or $1,000 worth of this particular stock. Now, if the company decides to do a 2-for-1 split, they will simply double the number of shares you hold while simultaneously slashing the price by half. So now, after the split, you hold 20 shares instead of 10, but each one is now worth only $50, not $100. This, of course, still totals up to $1,000, so nothing really changed as far as the value of your total holdings. It's just that the price and quantity that is adjusted. Now, 2-for-1 is a common split, but there can also be a 3-for-1, 4-for-1, 5-for-1, and some cases even 10-for-1 splits. It just depends on what the company management and board of directors want. There could also be a reverse stock split where your 20 shares would become 10, but the price would then of course double. So how a stock split is done is very simple and straightforward, but the much more important question is why would a company do this and what does it really mean? Stock splits are generally done when the stock price of a company has risen so high that it might become an impediment to new investors. For example, if a company's stock is $1,000 each, this would turn off some investors and may lower the number of buyers for the shares. A 4-to-1 split would make each share $250, which is a much more affordable price. It can then keep growing until it hits another high and then do another split. So as you can probably tell, a forward stock split is often the result of growth or the prospects of future growth and is generally viewed as a very positive sign. It means the share price is growing and needs to be split to entice even more interest in the company. Now, what about a reverse stock split that I mentioned earlier? Why would a company do this? Well, here things aren't nearly as rosy. If a company's shares drop significantly and come close to being a penny stock, doing a reverse stock split may be a way to inflate the perceived price and sort of cover up to make it look like the company's doing better than it is in order to attract more shareholders. This actually works because stock splits are virtually instantaneous and not everyone knows about them unless they follow that particular company, while the new price is noticed far easier. If you're thinking this is a bit misleading, well, no arguments from me, but it is legal and you'll see it on occasion. In fact, reverse stock splits have been used by large, well-known companies such as Apple, Amazon, Priceline, Netflix, and Citigroup in time of distress in order to regain investor confidence and avoid being delisted from a major stock exchange. So this financial tool will likely stick around. Okay, that was a quick overview of the fascinating world of forward and reverse stock splits. As always, if you enjoyed this content, please do like and subscribe, and I will see you in the next video.